Welcome, guys. Welcome to this investor awareness program in association with National Stock Exchange India. Today, I have Mrs. Rashna and Mr. Gaurav with us. Rashna is the Vice President at NSE in the Investor Awareness team, and Gaurav is the Chief Manager at the Investor Awareness team at NSE. So it's an absolute pleasure to host you all. And this session is very important for every investor who invests through equity markets or any financial or securities market, because recently with the post COVID, we have seen the advent of influencers, a lot of telegram groups, a lot of people don't know about any more of unsolicited tips are going in, and NSE, the exchange from itself, has taken this step to step in and help all the retail investors. So this is an quite a educational webinar. So, ma'am, I'll start with you. You can just give us a brief introduction about yourself, and then we move on to Gaurav and with the session ahead.
So, thanks, Gaurav, for setting the tone. And I'm very glad to be here, part of this session today. And I applaud this partnership that we are doing with ICICI Securities today, because it's a step towards making investors more aware. With the kind of retail presence that ICICI Securities has developed over a period of time, it's very important that both of us, the exchange as well as the brokers, partner with each other to spread the message about careful investing, about being a cautious investor, and at the end of the day, being a very smart investor as well. So this is we do a lot of programs. We do conduct a lot of outreach programs. You must have seen our social media. We keep putting up a lot of messages which are quite relevant to the problems that are faced by the investors from time to time. But the initiative about putting all together and spending some time with you, and also hearing some of the questions that investors pose to the exchange, is what we were interested in, and that's why we reached out to ICICI Securities, and today here we're doing this program with them. We wish you a very happy learning today, and we expect that we are able to meet the deliverables that you have set out for yourself out of this program. Thank you so much, and over to you, Gaurav.
Yeah, Gaurav Motwani. I think that Gaurav 1, Gaurav 2, both are Gaurav here.
Yeah, great. So as Rachna has already said that, there's a lot of focus these days on, it's very important for, introduce a different asset class to people. Unfortunately, we have a lot of people not being introduced correctly into the markets. So it's very important for us to the right kind of education that is important for people to get introduced to an asset class which will help them, right? So they need to understand what are the nuances that are there in the markets, or what are the do's and don'ts, for which the seminar is conducted today. And we've been doing this initiative throughout the year. So there are a lot of programs that, in case anybody else misses out, obviously this will be there live on the YouTube of ICICI. So they can go ahead and, later on, a lot of people can watch these particular sessions. Any doubts they have, obviously I'm sure ICICI will get back to you, anything. And in case anything you need to reach out to us, you can do that as well. So hopefully this session should be beneficial for all of the investors at large, and will let us together achieve this objective. And I'll thank again once ICICI for helping us, partnering with us, so that we can reach out to maximum number of people who are in either wanting to invest in the markets or are already in the markets.
That's always been the case, that even ICICI wants people to invest responsibly. So I think we have a presentation here, so we can start with the presentation and get down with responsible investing journey for everybody.
Right, great. Thanks, Gaurav. So we'll start off with, we have a couple of decks that we will take you through. First, I'll introduce you to some of the concepts of, the markets, and then Rachna will take over to get you slightly more in-depth into the markets. So I'll share a presentation which we have. Give me a moment. Gaurav, can you confirm if you're able to watch the presentation?
Yes, Gaurav, I can see the presentation.
Okay, great. So, right. So now, first and foremost, in this particular slide, we're going to cover slightly some of the basics of capital markets, which I would be covering, and then Rachna would take over to get you slightly more in depth, right? So basically, first and foremost, who is this module for? Who should go through this module? So, anybody who's now, has started investing slightly into the markets, they know small basics, and now want to get more, into the capital markets. They want to know about the brokers, the demat accounts, and stock investments. So anybody who wants to know, this is for them. And already people, those who have opened their accounts, there are a lot of things that we will cover over here, which will be something that they could take home with something new, right? So what will be the agenda of the deck that I will be taking care of is, first we talk about the capital markets and its structure. Then we talk about what is the primary and secondary markets, and then active and passive forms of investments. Then we talk more about investing in the securities market, knowing about the broker whom you open an account with. These, like, some of the account opening formalities, some of the important aspects, when you're dealing with your broker, and then some of the myth busters which are going around, which needs to be busted before you invest in the markets. So hopefully this will pave the right way for people to start investing in the markets. So first and the foremost is, what's the structure of the market that it looks like. So we try to keep it non-complicated. So simple part is, these are the people who are there, who comprise of the markets. First and the foremost is the investors, hence they are on the top. These are the investors, and then we have exchanges and clearing corporations and depositories, where the transactions do happen. And on the left side, you do have the brokers, who are the intermediaries, the investment bankers, and the mutual funds, through whom you would place the order for it to come to the exchange. And also we have the companies and social enterprises and the PSUs for which the prices are there, right? So these are the people who are there, who form the markets. Now, as we said, there are two types of markets that are there. One is the primary, the other one will be the secondary. So the basic difference here is that, you in primary markets is somebody who invests directly in the company, and then the company issues shares to the individual, right? So that is what the primary market entails. And secondary markets is all the shares which are already issued in the primary markets, and those investors need to exit, so they can exit it through the secondary market. So these are already pre-issued shares, which now people can buy and sell in the secondary markets. So that's the precise definition. And when it comes to price determination, please understand, in the primary markets, we do get this question a lot, who decides the price? So the price, the range is decided by the company in consultation with the merchant bankers for every single IPO that comes out, right? And in secondary markets, obviously it's the supply and demand, right? And the key intermediaries in primary markets will be your merchant bankers and the RTA, which is a registrar and transfer agent. And in the secondary markets, it will be your stockbrokers and depository participants. So in primary markets, when the company comes out for an issue, what is the purpose? It is a purpose to raise capital for different purposes. That's what will be mentioned in the offer document. And in the secondary markets, the purpose becomes providing liquidity, right? Those people who have already invested, if they want to exit or if they want to buy existing shares. So it provides liquidity. That's the primary difference between the primary and the secondary markets. Okay. Another important aspect for you to understand is active and passive forms of investing. So I assume we have a lot of people who are with us or who will hear us in the future, whether some of them will be experienced, some of them will be very new to investing. So active and passive forms of investing. So all the people who are very new to the markets, who are just trying to understand, who are getting introduced to the markets, we have seen a lot of people without understanding to heavily starting to trade in options, right? Please understand, options are being a very leveraged product. It is very difficult. You need to have a lot of experience. You need to have a risk tolerance. Risk appetite needs to be there for you to invest in such products. So first and foremost, a very nice way of entering into the markets would be through passive forms of investment. What happens in passive forms of investment is that there the money is working for you, where you aim to track the markets. The other part is it involves holding of ETFs and mutual funds. Third is they are less likely to outperform the market, because you're only trying to track the markets and get the returns as per the markets, which markets basically means your Nifty, for example, right? And so the transparency part is what stocks you're investing in, and then there's a lower fees and capital gains and other taxes that you will have to bear. So it's a very good form of getting introduced into the market, see how the market functions. So all the people who are new, they need to understand the dynamics that are involved. So it's a very good way of starting to invest. And the other part is the active form of investing. What you are doing here is trying to beat the markets, right? Whatever beta the market gives you, you're trying to gain more alpha over here. So you're trying to work and beat the markets. The other part is it involves actually buying and selling of shares. and you can exit as per your convenience. However, it's less tax efficient, right? So this is active form of investing. So we need to understand. So even if you're a passive form of investor, you need not worry, because if you see over a long period of time, that's when people are supposed to invest for a long period of time. You don't lose out. So research has showed, like, over 20-year period, if you are a passive form of investor, they outperform actually all the active funds over a 20-year long period, right? So investing in securities market is not like our T20 or a T10 or a 100 test matches, but it is like rather like a test match, right? So passive forms of investment is a good way to start with. So if you see the returns across different asset classes, now we will introduce why you should invest in securities market, or should we invest in securities market in the first place. So the part is, if you see the returns that you've been getting over the last 30-year, this is a compounded CAGR, right? Compound annual growth rate over the last 30 years. So our inflation is at 6.7%. Your silver, fixed deposits, gold, and public provident fund have been able to roughly give you around between 8 to 10%, right? However, in case you need more, obviously the equity markets have given you return of 15%. So in case you need to earn more amount, you have to take slightly more risk, and hence comes in the equity markets. So if you see the returns, average returns. Now I'll take you through another slide. This is what I want to highlight. So if you see from this for the last 30 years or 20 years, whatever we have seen, we have gone through many crises. There came a time at COVID when we did not know whether we would survive. Then there was the global financial crisis. There were some ups and downs. There was a war that we saw. So the Russia-Ukraine war, it has gone through many ups and downs. So we need to understand that the markets will not, grow in one direction. It will have its ups and its downs. There have been major incidents that have been an up, or major incidents that have got the markets down. However, if you see at the end of the day, it has given you those returns. So 15% returns is not that it has given you, I have subtracted those periods which are not good for the market. So it is a compounded annual growth rate of the entire thing, be it a good period or be it not so good period, right? So these returns are including all of this. Even it has crossed a time where, during a time of COVID, where we thought we may not survive. We've even seen that period, and that's the returns the market has given. Hence, the trust in the markets. So I imagine that, there is, after seeing this data, we definitely would like to get involved in the markets. So when you get involved in the markets, the very foremost thing that you would need to do is, when you start investing in the markets, you can do a passive form of investing through, mutual funds and ETFs to get involved. So in case you need to open an account with the broker, in case you need to ETFs, or you need to, invest on your own, then you need to open an account with the broker. So when you open an account with the broker, it's very important for you to go through the registration details. So SEBI issues the SEBI registration number to every single broker. So go through SEBI registration number, see the, what are the regulatory actions that have been initiated against the broker, what are kind of complaints that are pending against any stockbroker before getting involved with them. Try to, if there's a branch close to you, you can go there and understand with people, what kind of problems they're facing, or they're happy with it. Get some kind of feedback before you get involved with anyone. And, check, a lot of brokers will provide some facilities which are good, which you would like. So you need to understand what kind of facilities are provided by what broker. So in case you are somebody who's, who does not get too much into checking their emails or online trading, you want an offline trading, you want an RM who's for supporting with you. So there are different facilities provided by different brokers. So you need to understand what kind of facilities you want before you get involved. So the things like, you need to check what kinds of mode of trading they are providing. Is it online? Is it offline? Is it a combination? What kind of brokerage they are going to charge? What are the other key charges that they'll be charging to you? Whether they provide other facilities, like, if in case you need to apply for an IPO, you need not run all the way down to the company or the RTA to apply, or the bank. You can now the brokers provide these facilities where, they can just take your order on behalf of the company, right? They also have a lot of advanced toolings where you can learn how to start investing, and they have a lot of research and advisory facilities. So you need to understand what are the facilities that you need before you get attached to someone. So assuming that you get attached to someone, how can you place orders? You can place orders, visiting their office. You can place it via a phone call. You can do it through an email or you can use the app, right? So how does settlement happen? So first you place an order with the broker. He places it to the exchange. Then there's a trade gets executed on the exchange platform, and then the trades gets cleared. Then it is settled, and then the pay in and payout happens. This is the cycle of any trade in the secondary market. So now assuming that you have made a particular trade, you have bought or sold something, right? The moment you buy or sell something, you get in the market, when you buy or buy something, you get a bill. Same way, that same bill is now known as contract note in the securities market. So it's very important for you to see, it's a confirmation, the contract note that comes to you within by day end itself, the contract note comes to you. It's an affirmation that yes, the trade has been executed. And you need to understand, once you receive the contract note, we need to go ahead and check as to when did you place the order. It'll be the order time will be captured. Then there's a trade time, is when the trade got executed, which security was bought, what was the price, the quantity, what is the rate at which you have you've got the order for, the script for, and then the brokerage will be mentioned over there, and net obligation, what's supposed to be receiving or giving to the broker at the end of the day, right? So it's a contract note that will come to you, and I request everybody, moment you receive the contract note, please go ahead and check the contract note whether this is in line with what you have placed with the broker, right? So I'm assuming that during account opening, there are certain documents that I would urge you to go ahead and check. And I will take you through two mechanisms, which one is a pledge mechanism, the other one is a DDPI mechanism. The rest of the mechanisms are self-explanatory, hence not difficult. And also I'll take you through the running account part of it. So first and foremost comes the pledge. So initially what used to happen was, in case you needed to trade and you needed margin, so when you needed margin in terms of, so margins can be got in terms of funds, margins can be got in terms of securities. So in terms of securities, whenever you earlier needed margins, what would you do? You would have to transfer the shares from your demat account to the demat account of the stockbroker, correct? Now that transfer is no longer required. So that is now not necessary for you to do. What you can do is you can do a pledge mechanism. You can now get margins basis on pledge. So what you would do, that the entire share will continue to remain in your demat account. It will not move away from your demat account. It will be in your demat account. But to get margins, you can now invoke you can now opt for the pledge mechanism. So you have to, the pledge request can be given by you yourself, or it can be even by the stockbroker. So you can now ask the pledge. Moment you ask for the pledge, you will receive a link by email and SMS, and then it has to be a OTP authenticated verification. Once the OTP is given, then the pledge is confirmed. So what happens now is, the securities remain in your demat account. However, it is now pledged in favor of the stockbroker. The stockbroker henceforth, to give you margins, will again repledge it back to the clearing corporation, right? So you no longer have to transfer the securities from your account to the broker's account. It is done through a mechanism called pledge, right? So in your demat account, you will be able to see the securities which are free, and other securities which are pledged. So you'll be able to understand with that statement both, right? This is one mechanism. So henceforth, we will not transfer, but we will use the pledge mechanism. The other part what I would like to take you through is the DDPI, which is a demat, debit, and a pledge instruction. So instead of this is an alternative, something like an alternative to a power of attorney. So instead of power of attorney, which gives more power, a lot of powers it can give. So we can have alternatively choose for a DDPI. This is a non-optional document which says demat, debit, and pledge instructions. So this is only done for a very specific purpose. Now, in case you sell any, for example, you're selling some securities in the market, you have a demat account. Nobody can touch your demat account. So what do? You have to either sign a DIS and physically give it to them, or you can sign an EDIS slip, which is an electronic DIS slip. And in case you keep trading regularly, the other alternative that you have, instead of signing the DIS regularly, is opt for a DDPI. So DDPI can do three things specifically. I'll run you through a small infographic video, and I'll later on take you through the explanation. So I'll just come at the important point that I would like to highlight over here. Okay, so we have one instrument called the power of attorney that can give you multiple powers. So if you want to restrict the kind of powers that you want to give, what you could do is you opt for the DDPI. So there are only 3 specific purposes that this can solve. It can be only for meeting the paying obligations in case you're selling something. Only then you can choose for DDPI. If you want to pledge any securities, they can do DDPI. And in case there are any mutual fund transactions that you need to execute, you can do it through DDPI, right? So it restricts the powers that you will be able to give, limited to these 3 alone, right? So that DDPI is a very good alternative. Everybody must think of using this as an option. Okay. The other part that I'll take you through is the running account authorization of funds and settlement. Now, if you see clearly over here, it says running account of funds and settlement and does not talk anything about securities. So people who are new to the market, this is a small explanation. So whenever you are buying something in securities market, so the settlement happens on T+1 basis. So for example, if you have bought any securities within T+1, say Monday you bought something that is a T day, within T+1, the exchange will give those securities to the stockbroker, and the stockbroker will have another 24 hours to transfer it to you. So these days it comes within the same day. So roughly by T+1 by day end itself, you will receive the securities. Same way when you sell something, you're supposed to be receiving funds. So within T+1, you will receive the funds. So there are many people who do trading very regularly. So in case you are trading regularly, so there's an option for you, which is called the for running account authorization. So I would advise only people who are very frequently trading, only then this is useful. Else you can just leave it and not opt for doing this. So running account settlement is only allowed for funds and not for securities. So there is no more running account settlement of securities. That has to mandatorily come to your Demat account. The only option you have is for doing it for running account authorization of funds. So in case you choose, it's a voluntary document that you can go ahead with. And moment you choose for running account, so running account can be done as per your mandate, which is a monthly or quarterly. These are the two options that you have. And with effect from October 22, the date on which the settlement will happen is fixed. That's going to be on the first Friday. So you know exactly when your account will be settled, right? So if you're choosing for a daily settlement, then there's no headache for you to check. But in case you're not choosing and going for running account, it has to be on the first Friday of every month in case of a monthly settlement, and first Friday of every quarter in case you're choosing for a quarterly settlement, right? And in case you're not executing any trade for the last 30 days, then also you will receive any excess credit balance in your trading account back to your bank account. And running account of securities is not allowed. The stockbroker will have 24 hours from the payout time to transfer it to you, right? And as we discussed, in case you need to give for margins any securities you need to give, you will use a pledge mechanism and no actual transfer, right? So we spoke about a lot of things. I just cover some of the important aspects for y'all. So the contract note must come to you within 24 hours of the trade. These days, electronically, it just comes to you by the day end itself. Settlement of funds only are allowed, which can happen on a monthly or quarterly basis on the first Friday, whichever you choose. And there'll be no, in case there's no trade for 30 days, then the funds will come to your account. You must ask for them. And running account of securities is not allowed. For funds, it has to be voluntary when you choose, right? And stockbroker to transfer the securities within 24 hours of payout. And for margin, you will use a margin pledge mechanism. So these are some of the important sayings, very important for us to know. Whenever we are investing actively into the markets, it's very important for us to know to look at the quality of the business and not the hype that is created around a particular stock or a tip that we get regarding a stock. This is very important that I personally believe a lot in that, if you are willing to hold a stock for a long term for next 10 years, only then please go ahead and buy it. Else don't even own it for the next 10 minutes as well, right? There are thousands of stocks in the markets. Look where the bargain is, where you are able to get it for cheaper, right? That's what we do. Scrutinize how well the management is using the resources of the particular company. That's for studying the company, which slightly Rachna will take you through in more detail. these days we receive a lot of hot tips. Initially, it started with SMSs and emails. Now, with the advent of social media, it has moved away to social media channels a lot through Telegram, Instagram, YouTube, all the social media channels. We have a host of these tips coming out. And if you carefully look at these days, they've been very advanced, wherein they say that we are, after the entire tip that they give you, they will say you towards the end that it is for educational purposes only, right? Believe me, there's nothing called educational purposes only. Stay away from this, all of these stock tips, right? There's a reason behind why it is being done, which is we can take it for another session. So please don't believe in tips. There are research reports which are available. There are assumptions which have been made within the research reports. In case you believe those research, believe them, abide by them, then it is okay for you to adhere to the research reports, right? So one thing is, you cannot time the market. It is a practical and an emotional impossibility for us to do it. You cannot predict how it will behave, because we humans are involved. As long as we are involved, it cannot be predicted, right? So the best time for anybody to invest was yesterday. And in case the time is gone, the best time for you to invest is today. So no matter what time it is, let's get started. So a couple of minutes before we wind up my session is that stock market is gambling. No, it is not gambling. When we gamble, somebody wins, somebody loses. But if you buy in a stock, all of us buy a particular stock. In case stock price rises, then all of us benefit. There is no loser, right? So hence it is not gambling by definition itself. What goes up must come down. I showed you the particular chart. It went up, it came down. It went up, it came down. Eventually, at the end of 30 years, we saw it eventually ended up with positive returns, right? So what goes up necessarily does not come down for a longer period of time. Buy what's in the news. Tip, hot tip, given friends, they're giving you tip. Please don't do that. Even if the tip is true, by the time you react to it, there are professional traders who will log into the account and the price will already be accounted by the time you even try to place an order, right? So let's be in it for the longer term. In case you want to learn more about the markets, we have a lot of sessions which are already there up on our website. You can also go to the SEBI website, the Sarthi app, as well as the nseindia.com website. And I'm sure ICICI also has its own learning module where you can understand how the markets function, right? So with that, I'll end my session over here and I'll hand it over to Rachna to take you deeper into the.
So before Rachna takes up, I'll just there's a viewer who is asking, what are the benefits of DDPI? I think you've covered DDPI, so I think we'll take it up from you.
Right. See, as I told you, if you see power of attorney traditionally, I think in the 1990s when the power of attorney came into the picture. So since then, when it came into the picture, there were a lot of powers that it had, the power of attorney. Then this power slightly kept, being regulated, if I can say. It slowly kept coming down. So at one point in time, it felt like, the name power of attorney became very not very well known. Hence, there was a very need for us to change that. And now, hence, as I told you, there are only 3 restricted powers that you can give. So, people do not fear of anymore giving the powers. It's all now called by a different name called DDPI and restricted only to 3 points that we have discussed. It cannot go beyond that.
Okay, we'll come to the Q&A in the once Rachna finishes her part. So yeah, over to you, Rachna.
Yeah, my screen is visible, right?
Yes, it is visible.
Thank you.
I think one has to mute the audio. There's an echo coming in. Yeah, perfect.
So Gaurav has already briefed the nuances of the capital markets, has introduced some of the active and passive investing concepts as well. I take you to the next level of investing that we can call about. And we've aptly named it as Samriddhi, because we want people to be prospering in their capital market investments, and this becomes the path to. Yeah, and this becomes the path for wealth creation, and we want them to be completely aware of what are the various important aspects of investing into the capital markets. So here, what we've tried to tell you is that, what is the kind of audience, or what is the kind of people who are we wanting to understand and learn from this module. So we're saying that So what we're saying is that, you have already had some kind of an experience of trading into the capital markets. You know basic investing concepts. However, having said that, you are not, somebody who's taking a very informed decision making with respect to your own investments. You're not taking a very researchful decision of taking of investments, or you are still not, the decisions of investing are still not within your hands. So considering that, we want you to move towards a place where you're independently in charge of your decisions. We want people to be aware of what is that they should look into when they decide that, yes, this is the place where I want to be, this is the horizon that I'm looking for, and this is what I should be investing, and what is that you should look at before making these investment decisions. So basically, if you are somebody who is having a regular income but wants to have more income generation avenues, and have some goalposts in your mind with respect to either early retirement or higher education, or some kind of an plans where you think you would need additional funds, this is where this module can be helpful. What we're covering in this module is primary markets, various ways of investing in primary markets. What is the diligence that the investor should be involved into? Some aspects of secondary market, and we'll give you glimpses and some highlights about what is the investor protection that you need to be that we are here to talk to you about. Investor grievance, in case you have some matters that needs to be resolved and you need an intervention from the exchange. So what are the various avenues that's available there? And we are going to finally cap it up with some important points for you to know while you continue to invest and have prosperity in your investments. So primary markets is what I will be talking about. And I'm going to be saying primary markets is something, if I have to define in a very layman language, it says that this is the first time the issuer is tapping the capital, uh, and he is inviting the public to participate in the equity shares of his company. Or it could be a public issue where in the layman language, if I have to talk again, public issue, you have various companies filing their draft red herring prospectus with SEBI with the intention to issue shares to the public at large. You have their IPO opening, and finally the listing happens. So that's the primary first thing that comes into into a mind of any investor when we talk about primary markets, is the initial public offering, the IPO of any company, where the shares are launched, given to the public for subscription. But the other ways of primary market participation is through a follow-on public offering or a further public offering, wherein the company is already listed onto the stock markets. They've demonstrated their growth and success into the capital markets, but they need further capital for their growth. So they will issue a second offering, which will be out to the public, which is called as a further public offering. And the third kind of a primary issuance that happens is the OFS, that is the offer for sale. So in case of offer for sale, what happens is the company is listed entity, and the existing investors of the company want to exit using a capital market platform, and these shares are then given to new set of investors through the issuance on the capital markets. So these are the various ways through which the primary market is being tapped by the investors into the capital markets. So any investment that you decide to make, whether it is into the primary markets or it is into the secondary market, where it is very important for the investor to do its own due diligence. Now, how do you do your due diligence, and why should you do a due diligence? These are the two important things that come into the mind of people. Why should you do due diligence? Is because just this picture should say that why it is important for any investor to do diligence, because investing without due diligence is like driving on a highway blindfolded. The importance of due diligence is that it's kind of a proactive approach which enables the investors to know about what are the risks involved in their investments and what is the reward they are going to get out of their investments, and whether it matches with the risk appetite and the reward that they have in their mind. So that is why the diligence actually sums it up for an investor to take a very calculated and informed call. as to whether they should proceed with the investing that is presented to them, whether the investing opportunity that is presented to them, after making a diligence, after doing a diligence on them, to say that yes, this is where I want to be, and I am getting into this decision knowing what is in store for me. It also helps us to understand how the company or the investment opportunity has fared over a period of time, to know that, okay, if this is the path that the company has shown in the previous and it's performs in this steadfast way, where could I be in the coming few years? So that also gives you a probability to plot about where your investments could be in a futuristic environment. So, how do you conduct your due diligence? Where there are various information that is available, but the quick information, the quick things that a person should look at, the quick checks that a person should look at, investor should look at, is they should definitely look at the company financial statements. They should also look at how the sector is performing in which the company operates. The company's competitor also helps us to understand about where the company stands with respect to the industry, with the sector, and how the company is growing vis-a-vis their competitors, to know that, whether I am taking an investing opportunity in the right kind of company. You should also look at some of the facts which is for investing, which are not so tangible, but it is very important, because you have to know who are the people behind the company. It's very commonly said that, generally people take positions, or people take investing opportunity at looking at the people running the company, rather than only the company that is being listed. So it's very important that we should know who are the people behind the company, who's running the show, what is the management structure of the company, what is the governance practices they have in place, do they have any governance lapses which were known to in the public domain, which I could understand, and if there are, have the gaps been filled by the company. So all these pointers will make a person make a very informed decision. Brand value of the company obviously gives a lot of comfort to the investors, when they know that they are investing in a brand which speaks about trust and transparency. It adds to their investing credibility. And there are times when, people, the customers are extremely happy with the company that they are being serviced by, and that also makes an important decision making point, provided you have other comforts with respect to their growth, with respect to the financial sector, and as well as the competition of the company. The customer retention level of the company speaks well about how the company has been catering to its customers and its suppliers from time to time, and the confidence they have demonstrated from time to time again speaks a lot of the company. So these are some kind of signals, or kind of non-tangible things that an investor should look at before they take into investing decision on a company. So, with the social media and with the internet floating with a lot of information, it is also very important for everybody to understand that what is the information which they should really look out for due diligence, and what should be the source of information. Sometimes even overload of information can cause a concern, and people may not really know what to rely and what not to rely. So, sources of due diligence is very important. You should know that what information you're looking and where is it emanating from. So the best, some of the sources of information that I have put down here is that you should definitely look at the exchange website, because even if it's a new company that's proposing to get listed, they will be putting up the information onto the exchange website in form of a draft red herring prospectus, which will have information about the company since its inception, about its business, about its industry, about the promoter background, about the management background. If for companies which are listed onto the stock exchange, they will be publishing information from time to time with respect to their developments into the company, corporate announcements. They'll be also putting up information about their financial statements. So obviously, stock exchange website is one of a very authentic source of information provided for providers for due diligence. The second information is the information from the company itself. There are a lot of people who are registered as research analysts, and there are research houses. So they obviously do a lot of work onto the companies as well, and they conduct a lot of due diligence reports, which can be availed by the public. So it's important that those research reports also become an authenticate source of information for investor to look into. And social media, some of the information that's available on social media, which is backed by prominent platforms, which is into the financial services, also can be looked upon as sources of information for due diligence. Due diligence can be of a bottom to top approach, or it could be a top to bottom approach. There's a no right way or a wrong way of doing due diligence, or saying that this is, it could be a combination of one. So you could first look at the sector and then see that what are the strengths of the sector, and then drill down to which company in the sector is doing well. Or you could look at the company first and then go up to say that, okay, how the sector will perform over a period of time, and what is the industry outlook of this company, how the growth is trajected for this company over a period of time, the sector, any policy changes that are likely to impact onto the company as a long-term investment. So this due diligence has to be a combination of this information. It has to factor in the economy analysis, it has to factor in the industry analysis, as well as the company analysis. And it's important to look at while you do due diligence, it's important to look that you're looking at it from a long-term perspective of an investment, because Gaurav has also plotted a chart in which say that a steady investment flow and a steady investment is obviously yielding better results. So we would urge the investors to look at capital markets as for a longer term horizon, and they choose their investing opportunities, choose their investing companies, doing a due diligence. Choices are to them as to which approach they want to follow. But the crux of the matter is that there should be due diligence involved by the investor himself before they get into an investing decision. Some of the points I've already covered. It's a summing up of the information that I've already put on earlier. So two things which are new into this slide is you should also look at how the company is leveraged over a period of time. Are they over leveraged? What is the debt equity ratio, and how much are they exposed themselves to the debt, to the various banks and to the various other lending companies. That's very important to say that yes, this is where I want to be taking a decision. Other factor is also, please invest in companies where you think the business model is something that you're able to relate to and understand. If you think that the business model is complicated and something that is beyond your understanding, beyond your understanding of what is being said, then please do not get into investing into such companies. Please understand the business model and have clarity on what the way forward for this company is, and then accordingly take your decisions. So when it comes to primary markets and when it comes to investing, it's important to also know that we see everybody talking about what is the process of a primary market application, and how is an investor participating into the primary market. So the most common word that comes across is that primary markets applications are supported by ASBA. Now, what is ASBA? ASBA is purely saying that whenever you intend to subscribe to an IPO and you put in your bid is subsequently to be followed up by a blocked amount. That means the amount in your bank is also blocked to the corresponding value that you have put a bid for. Now, this ensures two things. One is that the amount is only blocked and it is earmarked for your subscription to the IPO. It does not move out of your bank account, which actually gives the investor a lot of confidence that yes, the amount is still lying with them, and only subsequent to the allotment, the amount will be moving out from his bank account to the escrow account of the issue. So this has cleared out a lot of problems that were emanating from the primary markets with respect to people not getting their timely refunds, people being overcharged with respect to their subscriptions. So this ASBA has actually been quite an effective tool to ensure that investors are able to bid, and the allotment decides on to what should be the amount that should actually move out from their bank account, and there are no much delays for the refunds to happen. So this has seamlessly smoothened the process of primary markets. So, like I said, as by application, the amount for the applied issue is blocked in the investor's own bank account. Please ensure that whenever you apply for primary markets, you are knowing that there is this facility, and this is how the process will work for. And once the allotment is confirmed, the applicable amount will be debited from your bank account, and the remaining balance amount will be unlocked. We've already in the earlier presentation seen about what are the various steps into order execution and matching. This is just a diagrammatic representation of the same as to when an investor decides to invest into the capital markets. There is a buyer and there is a seller involved. It's an anonymous order matching platform, so the buyer and the seller, the quotes will be available onto the stock exchange platform. The order matching and the execution will happen on a price time priority. And once the order execution happens, the obligations as to what has to be paid by the selling client and what has to be received by the buying client completely is done through the clearing corporation. So the netting of trades take place there, finalization of obligations are there, and the intimations goes out to the buyer and the seller in that order. So this is a diagrammatic representation which every investor should know about how does the trading and the settlement take place on the exchange. So you have an exchange which does the order matching and the execution, and you have the clearing corporation which is taking care of your finalization of obligations and the demat transfer and the funds payments and securities. So that's taken care by the clearing corporation, which is NSE clearing corporation in this instance. So like any other trade, in case of a buyer, he has to first pay the money to the clearing corporation or to the broker, and once the payments are made, they're passed on to the selling party, and the securities are received by the buyer once the payment has been received. So it's like any normal transaction that you do, that when you buy an invoice is raised onto you and you make the payment and then the goods are delivered to you. So similarly, even in the securities market, it's happening in the same manner, only there are timelines which have been fixed to it. So the settlement in this capital markets is on a T+1 basis. So T day being your trading day, and your settlement should happen on the next day, that is the T+1 day. Having gone through some of the investing terminologies and some of the investment fundas, I would just want to understand that I've put something in my slide which I did not explicitly speak about, because I wanted to know that how many of you all have really understood the whole thing that I'm talking and listening to me seriously. So it's a virtual session, but I expect all of you to sincerely answer to yourself as to which of these is not advisable by investing in securities market. I assume most of you know that it is A. A is not advisable into the securities market at all. So never ever deal in cash while you're dealing into the capital market. The next thing, that is, what is the minimum guarantee that is promised in the securities market? So D is the right answer here, which says about returns are subject to market risk and there's no guarantee and fixed return into the securities market. Please do not fall for prey to any other information about returns onto your investments. The complete truth is that returns are subject to market risk. There are no fixed returns assured into this capital market. Always remember this and by heart it as a mantra for all of you. So
I'm
just
sorry to interrupt you in this.
point about fixed returns, I will just put up some of the things that keep coming up, propping up into an investor's mobile app, applications, or WhatsApp, which keeps flushing themselves with this kind of information that you will get lured into and fall prey to. However, please understand that these do not fall true to their promises, and we see investors getting actually duped by these messages, by these kind of calls that are being made to them, and then they really don't know what to do about. And then what happens is ultimately a trust deficit into the capital market. And that is why here today, Gaurav and me are to tell you about that. This is a program, a session which should make you more conscious, cautious, and an alert investor. again, you will find some of the people talking to you about and giving you kind of a lot of tips about which stock is going to be the fire stock, the hot stock, the next billionaire stock. So there'll be a lot of tips coming into that section. Please do not again get lured by all this. There could be some kind of a malpractices that is going on behind putting up these scripts as the hot stock tips or something like that. There could be a group of people who are getting into a practice that is not in the right investor interest, and they could be kind of misguiding you and misleading you about investing into a tip which actually is got no credentials and no fundamentals about. So we have to be very conscious about which investment advice we want to solicit and which investment advice we want to believe in. And that is why I again come back to the point about it's important for you to do a basic due diligence or an advanced due diligence before you decide to invest into the capital markets. On what basis do you make your investment decisions? Please answer for yourself. And I would say that the right answer here has to be always your research, even if you're guided by advisors, even if you are guided by people who have been into the capital markets and you have a lot of trust on them. But in spite of it, do some basic research of your own to know that, yes, this is the company or this is the investment that I really want to go about and invest my money. It's your hard earned investment money. Please invest it very cautiously and wisely. But having said that, in spite of all these precautions, you have taken care and you have ensured that you do the right mechanisms of trading. You know your broker. You've also ensured that you are completely updated with respect to your documentation, and you've taken precautions to have a safe investment. But you still have something that didn't go wrong that didn't go right in the manner it was supposed to be, and you have a dispute with your stockbroker. You should immediately seek clarification from a stockbroker about what is the dispute that you think is that's bothering you, and how what is that you would want him to address to. In case you feel that the stockbroker is not redressing it in a manner that you think should be deserving its redressal, you must complain in writing to the stockbroker, and you must also inform the exchange and file a complaint with the exchange about your dispute to take it to the next level. In order to ensure that investors are having an handy access to complaints redressal mechanism, we've ensured that we have it a seamless process, an online process where investor sitting at the comfort of his own house with a handset in his hand can actually go and file the investor complaint with the basic documentation that he has. And what are the various investor grievance redressal mechanisms? So the process is very simple, but you should also know that what are the various ways that you can have an investor grievance redressal. So first step is when you have had a dispute, you would have tried to sort it out with your broker. If it's not working out in that manner, then you have to file a complaint with the exchange, which the department which will take care of your complaints is the investor services cell. So you must file your complaint in the scores with the investor service cell. In case you don't have a mechanism wherein investor service cell, you're not satisfied with that, you can go for arbitration, which is a quasi judicial process, and then there's subsequently an appeal mechanism, and then there's a court. But the recent mechanisms, there has been ODR which has been introduced, so there's a slight way the investor grievance redressal mechanisms henceforth will be taken care of. So you must be updated even what are the various avenues and mechanisms that is available to you. I've already touched upon this, that there's an online portal which you should actually use, and it's been widely used by the investors, and it's been very handy and seamless and very convenient for the investors to raise their disputes and get it redressed through this portal. These are the various steps involved in lodging a complaint. So you have to go to the scores platform, you have to register yourself, you have to provide your basic inputs about your PAN number, your UCC code, with broker you are aggrieved with. You have to tell what kind of a category that you have an issue with, and submit some basic complaint details, put your supporting documents and submit it to the exchange. Once the exchange receives it, then they'll go through it. There'll be some round of information seeking between the two parties, that is the investor and the broker, and it will be then put up to a grievance redressal panel or a individual who will look at your complaint. He is going to be an independent person who is going to listen to both the parties and pass an order subsequently. And one last thing that I want to touch before I close this session is that all of you who are investing into the capital markets will be getting various sets of documentation, various messages, and you will be also getting information about your trading activity over a period of time. But one thing that you must all look into is your client consolidated statement. It's a statement which gives you a summary and a details of all your investments across the investment asset classes with, yeah, and your dealings with both the depositories. So it's kind of your summary short of investments. At one click, you can be able to see all your investments. You do not have to go and look at 10 in case you have not looked at your various other statements and other documentations, or you have not looked at your messages. In case you have not been able to do that, you must surely look at your client consolidated statements to see that where your investments are and what is the value and whether it matches with actually what you have, what your trading activity has been. And once you're convinced about it, then good to go. Otherwise, you know that you have to go back and start with respect to your investor grievance process in case you think there's any gap there. These are quick things that I want to reiterate, and this should be something like all of you should remember all the time. Do not deal in cash. Please do not give any blank signatures. Do not sign on any blank forms. Though they may sound very convenient and though they may be very luring for you, which takes a lot of job away from you, it's important that you read your documents before you sign your KYC. Do not deal with unregistered intermediaries. It's important to know that who you're dealing with. Check for the broker that you're dealing with. Check for the intermediary you're dealing with. Unsaid rule: do not share your passwords in whatever online transactions that you do, whether it is broking or it is banking or it is any other transaction. Please do not share your passwords. Do not keep your funds idle with a stockbroker. Multiple mechanisms have been given to you so that you are able to give only what is relevant funds to the broker. So please make use of those mechanisms and do not keep your funds idle with a stockbroker, giving him an opportunity to abuse it or not use it in the manner that is desired by you. Herd mentality. I think most of the people in the stock markets do go for kind of common stocks which have been spoken very commonly between their friends and their circles and their societies. So this is something that we should avoid of and take very informed decisions. Invest in businesses that you understand. Do not try to time the markets because it's upon your horizons that you have selected for investments. It's not about the timing of the market. Please time your horizons. Please look at your horizons. Please look at your risk appetite and the rewards that you expect and accordingly deal in the capital markets. A big no for dealing with stocks which have come as tips to you all. And avoid all the kind of luring messages that you keep getting about huge returns, promising returns, assured returns. So they could use all the fancy language and the words that's possible, but please avoid acting on those messages. These are just to sum up to say that, for you to be an alert investor and for you to be a very cautious investor, it's important that you keep updating your records with the broker. In case of any change, inform them immediately so that you are updated with your transactions on a regular basis. Please provide your email ID, mobile numbers, which are in use by you and which you keep checking from time to time that your transactions are being as per the instructions that have been given to you. You should know about, what are your rights and obligations. You should know that what is the commission that you have to pay, what is the brokerage that you have to pay on your transaction, so that you're not being overcharged even on those areas. And no cash dealing. So that means that you have to do all your transactions through the banking channels itself. And if you need still more information about the securities market, these are the various places that you can look at. NSE India has hordes of information available on its website. You have a Sarthi app which is quite friendly for you to know about, again, learn a little more about capital markets. And SEBI has been very proactive in making information available to the investors, which will be very helpful to them and in a very user-friendly manner. So you can look at the website of SEBI as well for the same. And at the end, I'll just conclude saying that it's always been Soch kar, Samajh kar, and invest kar. That goes in the long way of the prosperity of capital markets and your growth into the capital markets. Thank you so much.
I had a question. So once you were in your PPT, it's clearly mentioned that do not fall prey of unsolicited advices, and especially on social media and through SMSs. And these days, we are finding a lot of people in the name of education, they are trapping people in their advisory thing, like they're paying 500 rupees, someone are even as low as 9 rupees, says 5 rupees to 20,000 bucks. So how should one avoid this? And if somebody really wants to understand or learn the markets, so is there a portal from SEBI, NSE portal you have shown already? So how should one deal with this menace?
So, I'll tell you, all the intermediaries, MIs, have been taking steps from time to time to say that, this is what is the recent trend which should be avoided by the investors. If you will look at, there have been various press releases that we have been actually naming the people, that these are the people you should not deal with. So even to the extent of naming and shaming has started by way of an intermediaries to say that these are the kind of people that you have to completely avoid. So I think what is important for investors is to firstly track their own dealings. Okay. Second is importantly is, in case they think that, they are not able to keep up to the mark with respect to their dealings, or they're not able to take a very informed
Your
decision.
voice, can you just hold your mic a little closer?
Yeah. So in case the investors still are, we all run short of time, and we still depend a lot on, people to guide you accordingly.
Right.
But one thing that they should look at is keep updating themselves with respect to what are the various malpractices that exchanges have been cautioning about, what are the frequent problems that exchange has been cautioning about, because we are very proactively doing that. And look out for names, and we actually, like I told you, we're putting up names to say that this is what you should avoid, this is the website that you should avoid. So I think these are things that they will have to take care. The investors have to be conscious about in taking.
Right. So basically, if somebody knows about these people who are like trading in like giving unsolicited advices and are not authorized to give tips to anybody, the investors can go to the portal on NSE and write a complaint against them, and the necessary action would be taken. And also, ma'am, there is I'm asking this from my experience, because even I have seen a lot of posts on social media. People will give tips and write for educational purposes only. This you should. So how do you deal with this? Because you write everything, and in the bottom you just mention that this is only for education purposes. So they just try to get away with that, but we know what is the end agenda for them.
So say we've all been students, we know that what is for educational purpose and what is for luring. And I think we're talking about people who are investing into capital markets, so they are not younger. I'm not saying they are experienced people who have dealt with capital markets. So educational purposes, like you are completely knowing very well that this is not an education. When I educate, it is about, the decision is left on to me as to how do I want to act on that information. It's for my learning. It's not for luring me to do something. So I think that's the differentiation that we will all have to start getting into.
Okay. There's one question in the chat box. Someone's asking, are assured returns possible in the market? I think you have taken the questions where you have mentioned market returns are subject to market risk, returns are subject to market risk. So yeah, I think the viewer has already got the answer, because recently I came across one post on social media assuring some X% return on daily basis. So which is still not possible, because even the top guys, the top bankers, the hedge funds can't do it. But people on Twitter or Telegram are able to do it.
Yes, right.
Yeah. Okay. So certain questions, ma'am, I'll just take up 2-3 questions. Even Gaurav, you can chip in with this. Sure. So once again, what is an ETF, ma'am? What is an exchange traded fund? So
I'll ask Gaurav to take it. He'll cover it.
Yeah. So the point is, the full form of ETF stands as exchange traded fund, right? So in exchange traded fund, what happens now? Let us take, I'll just try to explain it as simply as possible. Now, for example, we have a particular script. So when I buy a particular share, so you can buy and sell it on the
same day, you can do an intraday. However, there's no diversification because a single stock, it has single exposure to that particular company, right? And now, so it has a disadvantage of not being diversified. On the other hand, I have a particular mutual fund that has the diversification benefits. However, I cannot buy and sell. It is only done at the end of the day, NAV value, right, which is calculated at the end of the day. So I cannot do an intraday. So a mutual fund has a limitation and a share has a limitation. Now, how about I come up with a product that removes the limitation of both of this? So it's a passive form of investment where you can assume that it is a mutual fund with the benefits of diversification that can be bought and sold like a share. You can do an intraday on that, right? This is as simple as definition as you can get for an ETF. A mutual fund, a diversified mutual fund that you can do an intraday trading on like a script. That's your ETFs. And ETFs is a very, very good way to start in case, once you move to an active form of investing, when you want to buy and sell on your own, it's a very good form of investment to start with, ETFs.
There is another question in the chat box asking what is an SIP? What is a SIP? So it's a very basic question. I'm pretty sure he's a very new investor who has come into the market. Yeah.
Okay, I'll take that. See, I'll try to extend the meaning of SIP. So basically, in terms of SIP, basically means people associated SIP with a mutual fund, right? So please understand, SIP is it's like a behavior. It's an investing behavior, right? Systematically investing a fixed amount every month, right? So people associated with mutual funds, yes, they do. People have mutual funds that are way through to it. Even if you're a direct investor, right? You yourself, you have to be disciplined yourself, right? So you can fix it instead of it automatically being deducted from your account. You can invest X amount of money yourself every month systematically. Assume a lot of us over here who are there are salaried people. So you get your salaries monthly, right? So when you get monthly, it's easy for you to save monthly and invest monthly, right? So it's a behavior rather. It's a very good form of behavior. Through mutual funds is an automatic route. However, if you're an investor on your own and if you're getting salaried, so that's a very good form of investment where you can systematically invest a fixed amount every month. And as you keep growing the organization, obviously you will have your own, you will also grow, your salary grows. So ensure that additional amount of whatever you're growing, some percentage of it again goes into the SIP, right? So SIP principle doesn't say constant over a period of more than a year. It keeps increasing as your salary keeps increasing. That's the simple.
There's one more question in the chat box. That is, can you cite an example? Can you cite an ETF as an example? So I think he's asking for examples for ETFs.
The best way is the Nifty ETF.
Okay.
If Nifty goes up, your investment value goes up. As simple as that.
Absolutely, I think. And that's how you ride the Indian growth story basically via Nifty. That's the best thing. Another question is that everybody has this: how much should one diversify? What should be the diversification percentages? So can you just put some highlight there?
Again, if I, there's no fixed percentage per se. If I have to say, it again boils down to the fact that how much you want to be. It's again a risk reward. It's an horizon that you're looking for. So there's nothing good, bad, ugly about having only 2 stocks, or you can have 10 stocks, or you could have a kind of a short term. If you're a mutual fund investor, you're looking for a mid cap or a small cap and a large cap. So you can have a combination of them. So you're able to have a kind of a steady income with the large cap, but your small cap can bridge in the gap, or it can pull you down completely. So yeah.
I'll just add to what Rachna had said. She's beautifully put it. I'll just add another perspective to what Rachna had said. That most of us, when we talk about diversification, we take, investing in securities market specifically as a risky product. Please understand, when we try to diversify, we need to understand that there are products in the market that give low risk, medium risk, and high risk. Investing in securities market does not mean specifically it has to be all high risk products. Right. So there are a lot of, debt mutual funds and other kind of bonds that are there, which are less riskier. Right. So when we talk about diversification, it has to be an asset class. Right. It's not in terms of product alone. Right. So when we diversify, it has to be asset classes. So you have some amount in low risk products, some amount in medium risk products, and some amount in slightly riskier products. That will depend on your age. A lot will be predicted by your age as well.
And as the age goes up, equity should come down, debt should go up. That's the normal rule that everybody follows.
Yes.
Another question that I have, because even we do a lot of sessions for our investors. The post 2020 have seen a shift towards FNO traders. Like a lot of people want to trade options, and now we have expiry every day. So any like how should one take this route of FNO? Like should he be leveraged or should not be leveraged? Should be option seller or buyer? Any something for our option traders right now?
Yeah, I'll take that. As we said, like, most of us have, I'll quote something that I said again during my presentation was, investing in securities market must definitely be treated simply like a long-term test match, right? So first and the foremost is to understand how does the market function. So people who are there in the call, please understand first, we'll start investing in the markets, be a part of the investment growth story of India. That is one. And then we can move into options. So people those who are moving into options, one thing that we really need to understand is that is a very highly leveraged product. People without understanding the product start getting involved in it. That's where the issue comes, right? So there are three very important things that is very important for if you're trading in options. One thing is that you need to understand what the product is there. Second is you need to have a very high risk appetite, right? And third is the knowledge levels. You need to specifically have the knowledge as to what the product is and where you're getting into. So these three skills are very important for you to understand before you start getting into the options market.
And yeah, here I would just want to come in and say that you have to avoid herd mentality. It's very important here, because that's where people are getting lured into when you see so many videos saying that options is easy, there's no money involved, and you get in cheap, but you also get out very expensive. It doesn't turn out in the right direction. It can be expensive as well if it doesn't turn out in the right direction. So it's very important that you have to avoid the herd mentality. Those three factors that Gaurav mentioned have to be the primary decision-making factors.
Absolutely. And also avoid getting lured by fake screenshots, which is another menace which is doing in the markets. So I think there's we don't have any questions, and I think we have covered everything largely. So thank you so much, Rachna. Thank you so much, Gaurav, for taking time and taking this webinar for our retail investors so that they are educated and well informed about what all stuff are there in the market and the technical jargons that they should know when they come into the securities market. We hope to do further more such webinars with you guys, because this is an ongoing process and needs to be done regularly, at least with the gap of some months. So it is an absolute pleasure hosting you guys. Thank you, NSE, and thank you for making time on a Friday evening. Thank you so much.
Thank you so much. It's pleasure is ours as well.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.